let's talk about how that translates into the markets, because Romain and I were talking a little bit earlier about how you think about all of these bearish calls that were being made this time last year. A lot of them were predicated on the fact that interest rates are going to have to go higher to deal with that economy. That was right. How the market reacted was wrong. What's your view on how this translates into equities?
You're right. I mean, believe me, there was a lot of negativity just 4 weeks ago. I mean, 4 weeks ago, we're in a correction. Everybody was very worried. But I mean, the market is a forward-looking mechanism, right? I mean, we've had the high inflation. We know that. But we've been saying for a while, look at shelter, look at car prices. They are coming back. So again, it's not a perfect crystal ball by any measure here. But again, the yields to us are coming lower, right? The Fed is likely done. We're in the camp again. They can cut. Back to that productivity real quickly here. In the mid-90s, okay, the Fed hiked rates a lot in 94. Then they started to cut a little bit in 95. What also happened, though, we had higher productivity. What did that mean? Wages stayed high and inflation came back down. So again, history doesn't repeat itself, but often rhymes. Mark Twain, we all hear that and use it a lot. There are some similarities right now with the mid-90s. We're not calling for a mid-90s explosion in equities, but we think there's some real reasons to think we can have a couple years, Katie, of strong economic growth and likely continued stock gains. Yeah. We've been overweight equities since last December. Well, we're still overweight equities here.
On that productivity side, I feel like we've kind of gotten a taste of that. We were kind of joking a lot about Mark Zuckerberg's year of efficiency, but that year of efficiency actually proved to be very prescient here, because he basically said, look, you know, yeah, revenue growth might be constrained, but if we can trim a lot of the fat around here, this company will be stronger than it has been. You saw similar moves in Microsoft and some of the other names here. I guess the question, though, is that really going to spread to, I guess, companies that didn't necessarily have the balance sheets and the breadth that Facebook or Microsoft has?
Great question there. And again, we had a lot of productivity right at the start of the pandemic. Why? Because everybody lost their jobs, and a few of us that had a job had to work harder. So there was high productivity there. That's bad productivity. Yeah. Now we've hired 5 million people last year, another, 3 million ballpark this year maybe. There's a lot more productivity. People are trained. They're ready to go. They're ready to help their companies grow. So again, you know, could we have 3% GDP growth next year? We think it's possible. One other thing about everyone said a recession this year. It's a pre-election year. You got to go back to World War II, before World War II. Last time a pre-election year had a recession. So again, it just makes sense that this cycle has a lot of time left, to be honest.
Well, I'm glad you bring up the election cycle, because we know that.
Are you? We have to talk about it?
Well, I don't want to talk about the election specifically, but in terms of how it feeds into the market. And I think a lot of people kind of forget that. You know, politicians do a lot of things during election years, which tends to kind of keep the economy humming. But it begs the broader question, too, as to whether this market is just kind of coming full circle, right? We kind of forget that, what was it, a year and a half ago or something, we were at 4,700 in the S&P. We're just kind of working our way back to that right now. I guess the question is, how much do we overshoot that? Are some of those calls for 5,000 or more really realistic?
We would say they're realistic, and that's a great point. Stocks have really gone nowhere. S&P for a couple years, to be honest. But this year's really played out. Again, when you have a first-term president in the third year of the presidential cycle, like right now, up about 20% on average. That's ballpark where we are in the S&P right now. Next year, which is an election year, last I checked, when you have a first-term president, the last 10 presidents, stocks have been higher, all 10 of them up 12% on average. It's when you have a lame duck president, look at 1960, 2000, 2008. Now, there are some other scenarios, I get it. But again, there are some reasons to think that, hey, Washington, it is what it is. It's not red, it's not blue. It's about green, getting people happy and keeping the economy going. And those are some levers that Washington can pull, we think, into the next year.
Okay. Well, that's a very optimistic look. I always viewed Washington as brown for like the muck that found there. So, you know.
Well, there's a lot of historical reasons to like equities right now. And as Romain said, a lot of optimism coming from you. But what's the biggest risk in your view? What could go wrong in 2024?
Yeah, I mean, listen, inflation, the economy could maybe overheat, okay? I mean, if things keep going this way, then you have a little continued higher inflation, not our base case, but that is one potential worry. And then the Fed, you know, they took their foot off the pedal, maybe, although they haven't cut yet. I'm aware they haven't even hinted at that, but the Fed fund futures are saying that. But potentially, could the Fed take their foot off the pedal and then we have an upset alert? That could happen. And then just a black swan, the things that nobody sees coming, we know that. But all in all, things are still pretty good to us.
How in sync are the markets? Because I feel like earlier this year, you really had kind of assets going in different directions, because everybody was had different theories about where we were going. Are we kind of more in sync right now?
I think so. I mean, last year was literally one of the worst years ever for stocks and bonds, right? So now it's a little more normal. I mean, bonds are up, the ag's up like a 1% this year, but we know where stocks are. So I think it's getting there. And one final thing on that, everyone's talking about the Magnificent Seven. Yes, those 7 stocks have done amazing. But again, we're seeing a ton of participation since the October lows. Things are broadening out. Again, historically, that's a sign that this bull market has time as more stocks are participating exactly like we want to see, and we're seeing it.